In this video, we're going to talk about financial options. These are what are referred to as derivative securities. They have value because they're connected to something else, and that thing has value. So an option simply is a contract, and it gives the holder, the person that has purchased this contract, the right, and as it mentions here, not the obligation, right? You don't have to do this, but you can either buy or sell an asset at some predetermined price within a specified period of time. And again, it doesn't obligate the person to take action. It merely gives them the right to do something. Turn my pencil on, sorry. So let's think about some terminology. A call option is an option to buy something in the future. A put option is a right to sell something in the future. So we can think about the call like buying stock, right? The strategy for buying a call is the same as the strategy for buying stock. An option to sell, a put, is essentially what a short sale is, or you can just think about it, it is the opportunity to sell an asset sometime in the future. The strike price is the price that you have to pay to either buy or the price you would receive if you sell the asset. And of course, there is an expiration date. And as we'll see later on, these expiration dates are rather short. Most are less than 90 days. So 90 days or less is usually the expiration for most of these. And you can buy within, as they're created, they can be created with 30, 60, 90 days out. And of course, you can buy or sell anywhere in between that time frame. The exercise value is the value of the call if it were exercised today. So what is that value? Well, the formula is you take the current price of the stock and you subtract the strike price. So let's say the stock is selling for 60 and the current strike price on this option is 50. So 60 minus 50, the stock price would be $10, or the exercise value would be $10. But what if it were switched around, and what if the stock price was currently, and I'm going to write down here, currently 40, and the exercise price was 50. 40 minus 50 is negative, right? Negative 10. So the value cannot be less than 0. It can't be negative. So it's either 0 or some positive value. Now the option price is what you pay to actually purchase the contract itself. Now, there is a component to this, though, that says that there is what's referred to as a time value. If you take the option price and you subtract the exercise value, right, that is the additional value that you have because there's time left in the life of this particular asset. So for instance, the exercise price, or excuse me, the option price, let's go up to our previous example up here. So maybe this option up here, this one right here, right? Let me go back to my black so I'll point to the same thing. So maybe this price, you could buy this option for $12. So if you pay $12, the exercise value is worth 10. So 12 minus the 10 means that the $2 is the time value. So I don't like to usually talk about investing or these types of decisions as gambling, but it is kind of a bet, if you will. You're placing a bet that the price of the security, the underlying security, is going to change. If you buy a call, you're betting that the stock price goes up. If you buy a put, you're betting that the stock price goes down. So, what is the value of your bet? Well, part of the value is this time value that the longer you have, the longer the time is for your bet, if you will, to come true and you to make profit on your investment. The people who write a call, essentially, if you think about a bet, they're the people that you're placing the bet with. So for every new option, there is an investor who, and they have here in quotes, they write this option. Essentially, they just create it and they sell the contract. So if they write a call, essentially what they're saying is they think that the price is either going to stay right where it's at or the price is going to fall. You're buying the call, so you're betting that the price is going to increase. So there's two parties to every transaction. We have a buyer or an investor, and then we have somebody that we've frequently referred to as the writer. They're essentially the creator of the option. Now we have different kinds of options, and this is really, we're talking about call options here. But a covered option is when you actually have the stock that the option is written on. A naked option is when you do not have the stock that it's written on. So if you bet a call, if you buy a call, right, if the stock price goes up, you want to buy the stock, right? So the person that wrote this option, they could either already own the stock or not. So if they write the option and they own the stock, then that's called a covered option. So if you would exercise your right to buy that stock, they would surrender the stock to you for the exercise price. But what if they didn't own it? Then they would have to go to the market, buy the stock, and then surrender the stock to you. That's what's referred to as a naked option. When we think about these options and the prices, obviously the price moves over time. So we have three ways of thinking about the option. So if a call, I'm going to start at the bottom here. If it's at the money, that means that the strike price is exactly equal to the current stock price. You probably wouldn't want to necessarily exercise this because, as you'll see when we get to some valuation things, you might not make much money or you might not make any money. But if it's out of the money, that means you really don't want to exercise this. So essentially, you'd be paying, that's the other example I had up here. This option is out of the money. It has no value, has no exercise value. So you won't make any profit with that. So in the money means that you might want to exercise this option if possible. So again, it's just basically thinking about where the value of the option is. It's either, for a call, it's either zero, or If it's 0, that means it's either out of the money or it's at the money. Or if it's positive, that means that it is an in the money call. So there is profit that you could possibly earn. Now, there are things called leaps, and this is the exception, I guess, to the short-term idea with options, that they can have maturities that might be as long as 2.5 years. Sometimes we refer to these also as sweeteners. So what companies might do, let's say a company wants to borrow some money, but they're in a little bit of a bad financial position right now, but they really need to borrow some money. So what they might do is attach these options, these leaps, they may attach these leaps to the bond. So now you have an opportunity, if the company does get better and stock price goes up, etc., then these options would then become valuable, and this may convince an investor to lend money when otherwise they might be a little leery on doing that. So again, this slide shows the relative price to buy an option to the strike price. So if the strike price is $25, maybe the call option price is $3. So you would have to pay $3 to buy this stock. And we'll talk about this a little bit later, but let's think about this, right? So the stock is worth $25. Now the option price is going to, after it gets above 0, right, it's going to move dollar for dollar with the stock. So let's say that the stock price goes up $2.50. So that is a 10% increase in the value of the stock. So if you own the stock, again, it would go to $27.50. If you do that calculation, that's 10%. One of the benefits to the option price is the option price goes up like the stock price does. So the option price is going to go to $5.50. And hopefully you can see here that that's almost a doubled price. Now, I didn't do the actual calculation for this, but there is leverage involved when you invest in options. Leverage meaning you can magnify your returns. And the reason for the magnification, just to kind of go back a step, is that the option price is very low relative to the stock price, but it moves in value the exact same magnitude that the stock price does. So for this particular example, if the stock price is $25, again, this is a call, what is the exercise value? So it's $25 minus, if the strike price is 25, if the stock was worth $25, this option would have a value of 0. If the stock price were to rise to $50, 50 minus 25, the exercise value would be $25. So again, the value of a call option is the stock price minus the strike price. So what does that have to do then with market price? So again, we had the market price in a previous slide. This particular option is selling for $3. This option down here is selling for $25.50. Okay, or it would, if the price goes to 50, it would sell for $25.50. So what does that tell you about the value of the option and the investment that you're going to make? In this example, you take D, you take the price of the option, subtract the exercise value, and that gives you what's referred to as the time value. So in this case, the time value, if it's $3, the time value is $3. Down below here, again, the price is $25. The exercise value is $25.50. So the time value at this range is 50 cents. So again, the option the time value of the premium is the premium minus that exercise value. So if you look at what happens to values here, right? Here's the exercise value of the option. That's this straight line here. So for a call, as the price goes up, the exercise value increases, and the market price of the stock itself increases as well, but it's more of a curvilinear function, right? So as the price of the stock increases, the option value increases. But at the same time, the value of the premium decreases at the higher end. So again, you can see here's a bigger difference than it is here at the end. And basically the idea here is this is a decreasing leverage as the price increases. So there is a spreadsheet that's provided with this that refers to derivative investing. And for this example here, we have a stock price of $125. The exercise price is $117, and the current premium is $11.43. So what are the investment opportunities to invest in this particular call? So if you look, the call, again, the premium is $11. So if you buy this, you would have to pay $11, rounding off, $11.43. Now, when does this thing start to gain value? It's not going to gain value until it exceeds the exercise price. The exercise price being $117. But let's remember, you paid $11 for this. So if it's at zero, remember the exercise value is zero, but you've paid $11. So every dollar beyond 117, as it increases, you start to get your money back. If the price, right, goes from 117, if it goes up high enough, it's going to get to a point where you would then break even. Anything above that break-even point then would be a place where you would gain, all right, or you would then start having profit. However, if you are the person that's writing the call, you earn that $11.43 when you create the contract, when you sell the contract. And that value, you keep that money as long as it's not exercised. So you're going to earn $11. Now, if the stock price is going up, that means every dollar it goes up, you lose $1 in profit. And eventually it will reach a point where you will then have zero profit. Now, if it continues to increase, you can increase your losses. So if you kind of think about an investment strategy, if you buy an option, a call option, the most you can lose is the premium. And you can have an unlimited profit potential. If you write a call, the most you can earn is the premium, and you have unlimited loss potential if the stock price continues to go up. Now, of course, you would try to find ways to unwind this if it was moving against you and you if you owned the stock, it wouldn't be a big deal because you would just release or surrender the stock. But if it was a naked call, The stock price is going up and you're going to have to replace it. So if the stock price went to $138 and then it was exercised, somebody's going to give you $117 for this stock and you're going to have to surrender it. If you own it, again, if it's a covered call, you just give them the stock, no big deal. But if you did this as a naked strategy, then you're going to have to go out and buy the stock for $138 and then sell it to this person for $117. So that's the strategy of call options. Call options. It's like buying stock, or the strategy follows the same strategy as if you were out and wanted to purchase individual shares. So that's our video for this time. I'll talk to you soon.